You are welcome once again to the second lecture in Principles of Accounting 2. My name remains Dr. Clement Ogmaini. So we are looking at, in our first lecture, we talked about the bank reconciliation, and we also talked about partnership account. So in this second lecture, we are looking at other topics. We shall be looking at manufacturing accounting and incomplete records. So now, what is manufacturing accounting? Manufacturing account, also known as production account, is an internal financial statement used by businesses to track the cost of goods produced during a specific period, including direct and indirect costs. So when we are talking of manufacturing accounting, manufacturing accounting is meant for those companies that are into manufacturing of goods, and they have to include the manufacturing cost in order before they can enter into trading profit and loss account. In trading profit and loss account, that account is made for organizations or companies that they don't manufacture anything. Rather, they are just into buying and selling. But just like an organization like ShopRite, Just Right, and others, their own is just to buy and sell. But if you look at an organization like Cadbury, Nigeria Breweries, the Chi Nigeria Limited, you look at Guinness, all those ones are into manufacturing. So for a company that is into manufacturing, they need to prepare a manufacturing account before they can go into a trading profit and loss account. So manufacturing account help us to determine the cost of goods produced, and also it helps us to determine the total production cost per unit, and it helps us to set a price. So now, in manufacturing account, there are certain things that we need to have in mind. One, what is the purpose of doing it? What is the purpose of carrying out a manufacturing account? The first purpose is we want to determine to calculate the cost of goods sold. Like I said, without knowing the cost of goods sold, it will be difficult for you to know the production cost per unit. And without knowing the production cost per unit, it will be difficult for you to set price of that product. And also, it will be difficult for you to know whether you are making profit in manufacturing that product. So some of the things that are specific about manufacturing account is that it helps us to do the cost of goods produced. And also, it is an internal statement of account. It's an internal statement of account. And it's used internally for decision making. And manufacturing account also helps us to track. It helps us to track our use of inventory. The inventory here means the opening stock of raw material and closing stock of raw material, opening stock of goods in process and closing stock of goods in process, and also opening stock of finished goods and closing stock of finished goods. So it helps us, this manufacturing account helps us to track the material that we use in production, and also the manufacturing account helps us to actually understand some of the things that happen in the accounts of that organization. It helps us to understand the account of that organization properly. And with this manufacturing account, we can be able to determine our profit. We can be able to determine our profit. Manufacturing account help us to know if how efficient is the organization. It helps us to know how efficient is the organization. So manufacturing account help us to know if we are efficient in our production. It helps us to know if we are efficient in our production. And also, if manufacturing accounting help us to determine whether we are to, if we produce, it will be better for us, it's cost effective to produce or not. Manufacturing account help us to determine whether it is cost effective to produce or not. Because if it is not cost effective, there is no reason why you continue producing the product. Rather, you can equally buy that product from another manufacturer and sell. So there are certain terms that are peculiar to manufacturing accounting. There are certain terms that are peculiar to manufacturing accounting, which are not there in the trading profit and loss account. One is, in manufacturing account, we have the opening stock of raw material, and we also have the closing stock of raw material. We have the opening stock of work in progress and the closing stock of work in progress. We have the opening stock of finished goods. We have the closing stock of finished goods. So apart from that, we also have what we call the cost of labor. We have direct labor, we have indirect labor. Direct labor is the cost that we can attribute to units produced. Direct labor refers to the cost of labor that we can attribute to unit produced. Like in Lagos State, like in Lagos for now, if you employ a bricklayer to work for you, a bricklayer is expected to lay 100 blocks in a day. So if you are paying the bricklayer 5,000 naira, he is going to lay 100 blocks for that day. If you now need 200 blocks to be laid for you, you need to pay the bricklayer, and you need to involve two bricklayers. So two bricklayers will cost you 10,000, and they will cost you 10,000, and they will lay 10,000, 200 blocks. If you need to lay 300 blocks, you will employ 3 bricklayers, and you will pay each of them 5,000, making 15,000. So with 15,000, you have 3 bricklayers, and they will lay 300 blocks. The implication of this is that it is very easy for you to calculate the amount spent on labor to the output. It's very easy to trace it. But the one that cannot be traced like that, we call it indirect labor. Example of indirect labor, like in a place where there maybe you put a security man where operations are carrying on. The security man, if it is 1 or 2 of them, when your operations increase, it does not mean that you are going to increase the number of security. When in the case of factory workers, bricklayers, you can say, if I use 5 factory workers, this is the quantity they will produce. It cannot be so with security. It cannot be so with the administrative staff. So the one we cannot trace to the unit produced, we refer to them as indirect labor. But the one we can trace to unit produced, we refer to them as direct labor. As we have direct material, so also we have direct labor, so also we have direct expenses. Direct material means that the material used can be traced to unit produced. Just like a bag of cement will give you 40 blocks. 2 bags of cement will give you 80 blocks. 3 bags of cement will give you 120 blocks. That is the standard in Lagos State. So, which means that half bag of cement is supposed to give you 20 blocks. A quarter bag of cement is supposed to give you 10 blocks. In that case, that material, cement, can be traced to unit produced. So we call it direct material. But we have indirect material. You cannot easily quantify the quantity of light that you will need, light and energy that you will need to produce a certain quantity of blocks. Just like if you are using generator or if you pay NEPA bill now, you don't know that the NEPA bill you paid, can you trace it to the quantity produced? It is not possible. So we regard it, yes, it is, you cured it, but it is not traceable to quantity produced. So now that is why we say those ones are indirect. So we have like direct expenses. Another example of direct expenses is that if you have like those people running a franchise for an organization, maybe like you have a franchise from Mr. Biggs, you have a franchise from Petrazini, you have a franchise from Swiss Sensation, you have a franchise from Catalyzer. They can tell you that if a plate of rice is 2005, they can tell you that 500 on each plate of rice goes to them. So if that expense, if you can trace it, that if we send 10 plates of rice, 5,000 will go to the company that gave you the franchise. It's the same thing with royalty. In book publications, the author is entitled to 50%, which means that to the publisher, 50% is what he pays to the author. So if he sells 10 books, the 50% of the value of the sale go to the author. So in that case, you can easily calculate the total expenses to the total, you can easily calculate it to the total sales. In that case, it is a direct expense. But the ones that you cannot easily calculate, like I made example of electricity and fuel, all those ones, like depreciation, all those ones you cannot say that if you depreciate an asset, this is the quantity you use it to produce. No, it is not. It doesn't work like that. So it's an indirect expenses. So in manufacturing accounting, we now say that all the direct material, direct labor, and direct expenses, when we add them all together, we call them prime cost. The direct material, the direct labor, and the direct expenses, when we add all of them together, we call them the prime cost. The ones we classify that are indirect, which you cannot trace to unit produced, like indirect expenses, indirect labor, and indirect material. When we add them together, we say that they are factory overheads. Also, like we said before, you will have work in progress. But you remember in trading profit and loss account, there's nothing like work in progress. All what you have is opening stock and closing stock. But in manufacturing account, we have opening stock of raw material and we have closing stock of raw material. And we have opening stock of work in progress. We have closing stock of work in progress. We have opening stock of finished goods and closing stock of finished goods. So, and also in manufacturing accounting, we must first of all get the cost of goods, the cost of production or the cost of goods manufactured. Remember, in trading profit and loss account, what we have is cost of goods sold. But in manufacturing account, what we have rather is cost of goods produced, or we can also call it cost of goods manufactured. And that cost of goods manufactured is made up of the prime cost and the factory overhead. And that is what we use to calculate the cost of goods produced. So you have the format here. In preparing manufacturing account, we have opening stock of raw material. We had purchases. We had also carried inward. We less closing stock of raw material. Then we had a direct labor. Then we had indirect labor, so that we had direct expenses and indirect expenses. And direct expenses, direct labor, direct material. All this will give us our prime cost. Remember, I said that the ones that are direct, when we have them together, they give us our prime cost. The ones that are indirect, like direct, indirect material, which we cannot trace to unit produced, indirect labor, which we cannot trace to unit produced, and indirect expenses. All these, we add them up and we call them factory overhead. So the addition of prime cost and factory overhead is what gives us our cost of production. But in order to, if there was any work in progress at the beginning, you add it to the cost of goods, the cost of goods produced. Then you less the closing stock of work in progress. This will now give us the cost of goods produced. So from the cost of goods produced, we are able to now, if we now have cost of goods produced, it is then we now continue with our normal trading profit and loss account. We can less it from we can now less closing stock of opening. We can add opening stock of inventory, that is opening stock of finished goods. We less closing stock of finished goods. So then we will now have what we call cost of goods sold. It is this cost of goods sold that we will less from the total sales in order for us to have our cost of our gross profit. When we less our expenses, which is office expenses, wages, discount allowed, bad debt, depreciation, transport and traveling, we less interest paid. We also less in things like insurance, repairs and maintenance. When we less all of those, we will now have our net profit. So the manufacturing account, like I said, manufacturing is meant for manufacturing company, and they prepare it before they now enter the trading profit and loss account. For trading companies, it's only trading profit and loss account that they prepare. For manufacturing company, they prepare the manufacturing account before they can now prepare the trading profit and loss account. So, for as an accountant, you are working in a manufacturing company, you must be able to prepare the trading, the manufacturing account, then before you prepare the trading profit and loss account, following the format that is displayed in this material. Now, of what importance is this manufacturing account? Why is it necessary to prepare manufacturing account? What are the uses of manufacturing account? The first and primary uses of manufacturing account is that it enables us to determine cost of production. It enables us to determine the cost of production. Number two, it enables us to determine the direct material, the direct labor, and also the overhead, the indirect material, indirect labor, and indirect expenses. So we can, with manufacturing account, we can calculate the total direct, which is the prime cost, and the total of indirect, which is the overhead. Then we'll be able to, because we have calculated the manufacturing cost, a company can decide that if this is the manufacturing cost, but this will be an amount at which they are transferring the cost to the marketing department. Let's say a company spends 1 million in their production now. Maybe the production of a particular product is 1 million. And the company can say, okay, our total cost of production or cost of manufacturing is 1 million. But if we are giving it, if the production department is giving it to the marketing department, they will give it to the marketing department at the rate of 1.5 million, 1,500,000. So that means that the cost of manufacturing is 1 million. Then the transfer cost, they are transferring it to the marketing department so that marketing department can continue with sales to final customers is 1.5 million. Given now that the 500,000 is considered as a manufacturing cost, because in order to take up the pain to go and start manufacturing rather than buying, you must determine whether it is cost effective to manufacture. So you must make profit in manufacturing before you can start manufacturing a product. Alternatively, if you find out that you are not making any profit in manufacturing, you rather go and buy for the other manufacturer and just do the trading aspect of it. So in manufacturing account, we're able to determine the cost of goods manufactured, and also we now put something on top. We now put a value on top to get the value, the transfer price at which we are now selling it to the marketing department. So that is why I said that if the manufacturing cost is 1 million, the company can add any amount which represents the manufacturing profit to now determine the price at which they are giving it to the marketing department to sell. So it helps us, manufacturing account help us to determine the cost of goods manufactured, help us to determine the manufacturing profit, and also the transfer price at which we are selling it to the marketing department. The manufacturing account helps us to determine whether it is cost effective to buy already manufactured goods or to buy raw material and other ingredients and manufacture it ourselves. So it's the true manufacturing account that you can be able to determine that. And manufacturing account also helps us to monitor our inventory properly, because we are looking at opening stock of raw material, closing stock of raw material, opening stock of work in progress, closing stock of work in progress, opening stock of finished goods, and closing stock of finished goods. So manufacturing account help us in inventory management. It helps us in inventory management. It helps us in budgeting. It helps us in budgeting. It helps us in budgeting. And it helps us to also determine the level of depreciation of assets which we use in manufacturing. So manufacturing account is a very special account for manufacturing companies. So it is important to understand that not all companies just prepare trading profit and loss account. But for manufacturing companies, they first of all have to prepare manufacturing account before they can go into trading profit and loss account. So the next item, the next topic we will look into is incomplete record. Incomplete record. Incomplete record is a big problem in accounting. Like we said, when we were doing basic accounting, not many people understand accounting. Because some people don't really understand accounting, they tend to carry out do some recording which are incomplete. So it will not be difficult to ascertain the financial state of a company when the records are not properly kept. The records of a company are to be kept in accordance with the GAAP, the Generally Accepted accounting principles. We learned some of those principles in our accounting concept and conventions. So if an account is not prepared in consonance with the generally accepted uh, accounting principles, there is bound to be problem. So to prepare the statement of account will be difficult. That account will not be balanced. So what are the causes of incomplete records now? What are the causes of incomplete records? The number one cause of incomplete record is lack of technical skill. Like we said, not everybody is an expert in accounting. So those that are not expert in accounting, in an attempt to still record their financial transaction, they might record it wrongly. So it leads to incomplete record. Also, we also have situation of informal accounting practices. Informal accounting practices. Informal accounting practices. This is a situation where some business, particularly small ones, may use single entry for simplicity system, for simplicity. In short, most of those small companies, small businesses, shops, and all that, they normally use a single entry. You will see that it's the same book they're using for purchases. There's the book they're using for cash book. There's the book they're using for sales. There's the book they're using for to record debtors. There's the book they're using to record creditors. There's the book they're using to record a bank transaction. So at the end of the day, there is a mix-up. So what they just do is that they just have a diary which they are using to just record any transaction that takes place. They just write the date and write the transaction. So no account is debited, no account is credited. So it leads to incomplete record. Incomplete record can also occur maybe due to loss, due to damage, can lead to damage of records, can also lead to incomplete records. Even in this era of digital era, there could be corruption. Maybe virus can corrupt some documents and can help affect the account record of the company. So when there is also inadequate systems to record things, can lead to incomplete record. And also fraudulent staff can deliberately omit some transactions in order to conceal revenue generated or to conceal their illicit and fraudulent activities. So some fraudulent staff can also refuse to enter some record, or they enter it wrongly. Then incompetence. When somebody, even if is an accountant but is not competent in maintaining records, it can lead to incomplete records. So what is the impact of incomplete records to an organization? What is the impact of incomplete records? How does it affect an organization? Normally, when there is incomplete record, the first problem is that there will be difficulty in preparing the financial statement of the company. It will be very difficult to prepare the financial statement of the company because the records are not complete. So you cannot prepare a trial balance, and you cannot prepare a trading profit and loss account. You cannot prepare a balance sheet. You cannot prepare a statement of cash flow, and also you cannot prepare a statement of retained earnings because the records that are available to you are incomplete. Because the records are incomplete, it will be very difficult to comply with tax to comply with the demands of the tax office. That is why you see that many companies, they don't put signboard in front of their company. Some will run away when tax officers are coming. It's not because they don't really want to pay tax, but because they don't have complete accounting records. And so it will become difficult for the tax officer to ascertain how much that company is supposed to pay. And because of this difficulty, there is no financial statement prepared. The tax office can decide to bill them any amount. So, to meet up with the tax requirement, you must have complete records. You must prepare your statement of account. But when there are incomplete records, you cannot prepare statement of account, and you cannot also prepare you cannot also comply with your tax obligation. Then we also have there is if we have incomplete record, it will be difficult to detect fraud. It will be difficult to prevent fraud. It will be difficult to detect fraud. When there's incomplete record, the company will find it difficult to detect and to prevent fraud because the records are not complete. Then, because of incomplete record, it will also be difficult to prepare what we call analysis of financial statement. Analysis like currency ratio, which is the current asset over current liability, it will be difficult to prepare it. Profitability ratio, which is the net profit all over sales times 100 over 1, it will be difficult to prepare it. It will be difficult to determine the equity and debt. It will be difficult for you to prepare return on asset employed. It will be difficult to prepare return on equity, and it will be difficult to prepare return on investment. So this economic analysis helps us to have an in-depth understanding of how a company performs. So when we don't have all those things, when the records from the beginning are wrong or incomplete, it will be difficult to prepare those, to engage in all those analysis. But there is accountants have decided to come up with some of the ways we can improve or still try to get a fair and a true and fair view of the records. We can so to handle incomplete records, the first thing you do is you convert all the records into double entry. The first thing you do is to convert all the records into double entry. After you have done that, what we mean is that the record, if they were recorded as single entry, just like a diary, you say day one, sales was made, day two, purchases was made, day three, NEPA bill was paid, day four, repairs and maintenance were paid, day six, salaries were paid, like that. If the records are in a single entry like that, the first thing you do as an accountant, you post them using the double entry. If sales are made and cash were collected, you go to the sales, you open a sales ledger, you credit the sales ledger with the amount, then you go to your cash book, you debit cash. If you pay NEPA bill, you go to your cash book, you credit cash, then you go to utilities or NEPA bill or utilities ledger, you debit utilities. If it is maybe repairs and maintenance, you debit repairs and maintenance ledger, you open your cash book, you credit the repairs and maintenance. So when you open all the ledgers, you carry out double entry, at the end of the day, you will be able to extract a trial balance. Another way is that you use the available information, such as if the information are incomplete, you use the available information in the cash book, in the bank statement, and other records, because the bank statement can give you a story of how the company were making lodgement and how they were making withdrawals, and also any charges that was made, any transaction that was made through the bank, it will be recorded in bank statement. So if you have a situation of incomplete record, you can look at the cash book. Then also you go and demand for the bank statement. It gives you an insight of how you can do a reconciliation of all the transactions. Then after you have done that, you now prepare a statement of affairs, which shows the assets and the liabilities at the beginning and at the end of the period. This can help us by determining the opening and the closing capital. So, like what we are saying here is that in accounting, we have accounting equation, which says that total asset is equal to liability plus capital. So you can start, because the records are not complete, you go to when they started this business, what was the total capital? What was the liability? What was the money borrowed from outside? Then you now say, okay, and what is the total asset? Because the capital plus liability will give you asset. It will give you the total asset. You check that one at the beginning of the operation. Then you also check at the end of the year, what was the capital, what was the liability, and what was the asset. So by preparing this one, it can now give you an idea of some of those transactions that are missing, which can lead you to carry out a proper investigation. Because if the capital grows, there must be evidence of, say, maybe the shareholders brought in more capital, or if the capital reduced, maybe there was withdrawals and others. So if the liability increase, then means you have to check things like trade credit, you check things like overdraft and bank loan. So the asset, if the asset increase, you check both the current asset and the fixed asset. The fixed asset includes the premises or land and buildings. It includes the plant and equipment, and it includes motor vehicles, and it includes furniture and fitting. That is the fixed asset. The fixed asset is the premises, the plant and equipment, motor vehicles, and furniture and fitting. While the current asset of a company will include the stock, the debtors, prepayment, short-term investment, cash at hand, and cash in the bank. Then on the other side of the balance sheet, we have the capital, we have the long-term debt. Then below it, we have the current liabilities, which include overdraft, trade credit, and accrual. So with this, it will help you to trace why they are not balanced. If they are not balanced, you now able to trace the transactions that causes the imbalance. Then you also, by also trying to calculate the profit, will help you to determine the the imbalance or what causes it, and will help you to trace some of those transactions that were not properly recorded. So incomplete record is a good thing. You need an accountant that has expertise in accounting to be able to prepare the normal account from incomplete record. There are different methods of doing it, and all these methods are applied in the material. So these principles of accounting 2 is what we have taught now is just a tip of the iceberg. You need to know more. You need to buy books in accounting. You need to engage in private studies. You need to, so that you can have an in-depth and a clearer knowledge of accounting. So this is where we are ending principles of accounting 2. My name remains Dr. Clement of Bani. Thank you and God bless you.